This material is made available to you by or on behalf of the University of Melbourne under Section 113P of the Copyright Act 1968. It may be subject to copyright. For more information, visit the University Copyright website.
Welcome to Lecture 8 for Course Theory of Financial Accounting. Starting from today, we're going to talk about a new topic. So part 3 of the course about stewardship role of accounting information. You already know part 1 is measurement recognition, part 2 about valuation role, and now part 3 about stewardship role. So before I start with the content, let me briefly talk about the midterm survey. We really appreciate your feedback, your comments about the survey. Some good areas. Most of you find the level of the material is at the right level, not too difficult, not too easy. The workload is fine. And you think the seminars are helpful for understanding the material. Now, more important, the things we want to improve in the second half of the course. Some of you provide the comments that in the past lectures, some of the lectures are usually pretty quick, pretty slow at the beginning of the lecture, but go relatively quickly approaching the end. So we will certainly pay attention to this problem in the following lectures. And then some of you mentioned the structure of the course is somewhat clear, not very clear. So starting from this week, we'll give you more discussion on the structure, connection among the topics. Some of you asked questions about the exam. You are concerned how the exam gonna look like, what type of question you can expect to have. Questions will be similar to seminar questions we have discussed in the past weeks. That's one thing. And you're going to expect to have both calculation and essay questions in the exam. On the exact percentage, I'll give you more detail in week 12. In the last week, we'll give you a review and give you some more information about the exam. Whether you can expect to have some formulas provided, what kind of formulas, I'll mention to you in week 12. Also, one sample exam will be posted on LMS in week 12. For structure of the course, you probably know it's 3 parts. We divide the 12 weeks into 3 parts. Part 1, so overall the course is about usefulness of accounting information. And in part 1, we talk about how accounting rule affect the usefulness, how recognition rule affect the usefulness, how measurement rule affect the usefulness. And we say these rules will change the relevance as well as reliability of accounting information. Then in part 2 and part 3 of the course, we assess usefulness by looking at how accounting information can reduce information asymmetry problem in capital market. So in the very first week, I already mentioned we can divide information asymmetry problem into 2 types. One is adverse selection, the other one is moral hazard. So part 2 will be about accounting information reduce adverse selection problem. Help investor to value the firm. So we call this as valuation role of accounting information. And we use 3 weeks to talk about valuation role. We first talk about market efficiency, about whether investor use information or not. So that's in week 5, week 6. We establish the usefulness of accounting information by looking at the market response. And then week 7, valuation models. So how investors actually use accounting information. They get the information, they put in valuation model to estimate intrinsic value of the firm, and then they can make the investment decision. So that's the structure for the valuation role. Starting from this week, we're going to move on to this stewardship role, also called as contracting role. The problem here is the capital providers, either debt holder or shareholder, they cannot observe managers' action. They don't know whether managers use money for their best interest or not, we see accounting information can be used in contract to motivate the manager, to monitor the manager's decision making. So that's stewardship role. In this course, we're going to cover two types of contract. This week will be about debt contract. And this contract is about the relation between the firm and creditors. So creditors, we also call it as debt holders, the same thing. Next week, we're going to talk about compensation contract. This is the relation between the shareholders and the managers. So they take different perspectives. For the two contract topic, we will use the same structure to discuss the content. So for both weeks, lecture 8, lecture 9, we will first talk about the agency problem. This week is debt contract, so agency problem will be between the manager and debt holders, or say the creditors. That's the problem. And then we say accounting information can be used to solve the problem. So second topic, role of accounting information in debt contract. Third topic, impact of accounting policy on debt contract. Given the time for the lecture today, we won't have time to cover the third topic. We will not discuss accounting policy. Next week in the seminar, we're going to have one exercise, talk about impact of accounting policy on debt contract. So today will mainly be about the first one, agency problem, and the second one, role of accounting information. Learning objectives, straightforwardly three things. The first one, understand agency problem between manager and debt holders. Then role of accounting information in debt contract. And after next week's seminar, we hope you can evaluate the impact of accounting policy on debt contract. Ratings. A paper. Very long paper, we only require to rate 3 sections. General advice about rating paper for this course, you don't want to pay too much attention on details in the papers. This is a literature review paper. They have summarized how the literature has studied the problem. All the paper discussion are not directly relevant to the course. Only the basic idea is relevant. So when you read the paper, understand the lecture slides first. Only use the paper as the reference. You only need to know the basic idea discussed in the paper. You don't need to know all the details about the literature they have discussed. That's the same for all the academic paper rating for the course. Let's start with the first topic for today, contract and agency conflicts. So for the following few weeks, we're going to have a lot of discussion on so-called agency relationship. This is defined as relation between usually two parties. In this course, we will only consider two parties. One party will delegate decision to another party. So suppose person A delegates some authority to person B, then we call person A as the principal, we call person B as the agent. We already mentioned we're going to cover two types of agency relation in this course. One is debt holder and the manager, and the other one is shareholder and the manager. So in both cases, debt holder and the shareholder are the principal. They provide capital to the firm. They delegate manager to use capital to invest in the project. So they are both the principals. And the manager used the capital to provide return to shareholders or debt holders. So they provide service, they provide return, they are the agent. We have the principal, we have the agent. Manager is always the agent. And in the agency relation, usually there will be problems, there will be conflict. The conflict mainly arises because two parties want different things. Shareholder, debt holder want manager to work hard to get investment return, but the manager might want to enjoy life, not working hard. So they want different things. In other words, manager, the agent, is not act in the principal's best interest. This will not be a problem if we have perfect information. If we can observe managers working hard or not, we can directly punish the manager if he's not working hard. And we can reward the manager when he's working hard, so we don't have a problem at all. There will be a problem if we have information asymmetry. We can't observe managers working hard or not. We don't know whether manager is invest in a very risky project or not. So you can see we have problem when both conditions are satisfied. The first condition, two parties want different things. One is not act in the best interest of another. And the second condition is there is information asymmetry between the two parties. We have a problem. And we say contract can address this problem, can address the conflict between two parties. Usually, we define contract as the agreement between the parties. So, agreement between the debt holder and the manager, or agreement between shareholder and the manager. In this agreement, they can specify a lot of things. They can specify what is the responsibility of the manager, what reward, we say as price, they will pay for the manager. For debt holders, how much interest they want. That's also a price return. More importantly, they can define what to do in the event of certain foreseeable contingencies. So let's talk about this. What to do in the event of certain foreseeable contingencies. Think about debt contract between debt holder and the manager. Debt holder know after I lend to the firm go to issue a lot of new loans in the market. Then I will unlikely get my money back. As the debt holder, I know if the leverage of the firm is really high, I will have more risk. I will be unlikely to get my money back. In that case, I can specify in the loan, in the debt contract, if leverage ratio is too high, the firm cannot issue new loan anymore. So debt holder anticipate this leverage problem. Leverage being too high is this foreseeable contingencies. In the contract, they mention if leverage too high, the manager cannot issue new loan anymore. So they specify what the manager should do when these conditions are satisfied. When they define these foreseeable contingencies, it's usually based on accounting information. You will see a lot of examples later on. That's how accounting plays a role in that contract. We say that contract in general can provide the principle because it's based on legal system. It's based on regulatory system. If manager or the firm violate the debt contract, the debt holder can sue the firm to court and ask for compensation. So that's how they were protected. The principles are protected. So two types of contract. One is in the debt market. The other one is in the equity market. So for contract in the debt market, one thing to mention here, when we consider this agency problem, we assume the manager and shareholder are a team. They have aligned interest. This is by assumption. If we don't make the assumption we have three parties, the contract becomes very complicated. So to simplify problem, when we consider that contract, we assume manager and shareholders are a team. They have aligned interest. Then the conflict will only be between the firm, which consists of the manager and the shareholders, and the creditors. So that's the conflict in that contract. And then that contract can solve the problem. between the two parties. Next week, we're going to talk about the equity market. In this case, we relax the assumption and consider manager and shareholders as two separate parties. We don't consider debt contract anymore. We only focus on manager and shareholder. We assume they are two separate parties. They have conflict, want different things, and we have agency problem. Then compensation contract can solve their problem. So that's for the next week. In the contract, so in the two lectures for contract, two big questions we're going to focus on. One is why could contracts help address agency conflict? And the second big question, how does accounting information play a role in the contract? So we will answer these two questions in the debt contract setting today. Now let's focus specifically on debt contract. At the beginning, let's give you a little bit background information about debt financing. You might already know this. Overall, debt financing is a very important capital source for the firms. If you look at the number, more than 95% of financing was raised in the form of debt. Then the residual 5% is in the form of preferred shares or common shares. So that actually plays a more important role for the firms. The debt financing can provide some benefit as well as some cost to the firm. The first benefit, lower taxes. This is probably straightforward. When firms raise debt, they pay interest expense, and this expense can reduce taxable income, lower the tax for the company. Second benefit from debt, reduce agency cost stemming from free cash flow. We say there's agency problem when firm has too much free cash flow. Imagine a company has a lot of free cash laying on the account. The manager will be likely to be careless when he uses the cash. He might use cash to expand the business for his self-interest, but not for the interest of the firm. We call this as empire-building incentive of a manager. Manager use cash for his self-interest, not for the interest of firm. This is usually called as empire building. Intuitively, manager want to run a very big firm. He got utility from running a big firm, so he will use cash to expand the business, to do mergers and acquisitions. But this is not necessary for the interest of shareholders. So that's empire building. Now, having debt financing can reduce this cost from free cash flow because the firm has to pay interest expense every period, has to pay back the debt in the end. These all require cash. So manager will be more careful to use the free cash that can reduce this agency problem. Last problem, reduce agency cost because the lenders can monitor the firm. This is usually about lending from a bank. When you get a loan from the bank will monitor how you perform, whether you can pay back the loan or not. So that can reduce agency problem, can monitor the manager as well. 3 benefits. Now 3 costs. The first one, distress cost. Any idea? Very good. Company may not be able to pay for the debt. And distress cost is relatively speaking to equity financing. When firms get capital from shareholders, they pay dividend back to shareholders. But dividend is not compulsory. It's at the discretion of the manager. If earnings are low, firm can choose not to pay dividend. However, for debt, the firm has to pay back the interest every period, has to pay back the loan every period. If they cannot pay back, they will go bankrupt. So we call this as distress cost. cause problem to go bankruptcy. Second one, when there's debt financing, there's different problems, different agency conflict between shareholders and the creditors. We will have a lot of discussion about this later on, so let's postpone this for a few seconds. For the last cost, hold-up cost, in case of relationship lending. Hold-up cost is related to a problem called hold-up problem. It arises in relationship lending in relation between customers and suppliers in your daily life as well. One example, you have a good friend. You share all your secret with this friend. And later on, this friend is doing something upset you. You think about break up your relationship. But then you might concern whether he or she will still keep your secret or not. So because of this concern, you might be reluctant to break up this relation. That's the hold-up problem, the hold-up cost. You share too much secret, so you get concerned. Your friend will have more bargaining power against you. Similar idea applies to relationship lending. A firm gets a loan from a bank, share a lot of private information with the bank, then the bank will have bargaining power against the firm. They can charge higher interest rates. They can be more strict in the debt contract. Question for this hold-up cost. Then let's move on to the second one, this conflict between the firm and the creditors. So we already mentioned the conflict becomes a problem when two conditions are held at the same time. The first one is they want different things. The manager or the shareholder have incentive to engage in action for their self-interest at the expense of creditors. That's the first condition. Second one, there's information asymmetry. Manager know more information about the firm than the creditors, so we have the conflict. For the conflict in debt contract, we will give you 4 specific examples of conflict. The first one, dividend, then asset substitution, future increases in debt, and underinvestment. Let's talk about them one by one. The first one, dividend. The conflict with dividend is when shareholders increase their dividend payment. There will be less resources left inside the firm to pay interest to debt holders or to pay back the debt in the end. Shareholders increase their dividend, then there's less resources in the firm, so less resource to pay back interest or pay back the debt. Now, we can see one example related to this dividend conflict. Suppose we have a creditor named Mr. L want to invest $1,000 in a project. Assumption here, we assume Mr. L is risk neutral. So the first thing we need to understand, what is risk neutral? What is risk averse? Doesn't care about risk. Very important concept for the course. In the valuation part, we say investors are risk averse. Here we assume it's all assumption. You can assume investors are risk averse or risk neutral, depends on the issues you are interested in. So here we assume risk neutral means Mr. L does not care about risk. If it's risk averse, then the people dislike risk. So to elaborate on this risk aversion concept, let's talk about one example. We see a gamble. We give you 2 options and let you choose between the 2 options. The first option, we give you a fixed payment of $50. you will always get $50. The second option, it's a gamble, meaning with 50% of the chance, you will get $100. With 50% chance, you get nothing. If you choose option 1, raise your hand. If you choose option 2, raise your hand. Nobody choose option 2. What does it mean? Or one person choose option 2? 2, okay? So for people choose option 1, that is risk neutral, risk averse, or risk taking. Risk averse. For the second option, it can be risk neutral, it can be risk taking. Risk neutral, people does not care about risk. For the two options, expected return is the same, it's all $50. But you have a strict preference to the first option, the fixed payment, means you dislike risk. Even expected return is the same, you prefer the one without risk, so that's risk averse. If you prefer the one with risk, that's risk taking. Now let's change the options. Second option is still the same, a gamble. 50% chance, 150% chance, nothing. The first option, only $10. Still fixed payment, only $10. If you choose option 1, please raise your hand. Option 2? Now, everybody switch to option 2. What does it mean? Expected payment difference, $40. Option 1, fixed $10. Option 2, expected payment, $50. The difference of expected payment, $40. That's your risk premium to take the risk. Now you're willing to take the risky option because you got a higher expected payment. So for risk averse people, I have to pay you more to encourage you to take the risk. How much more? That's the risk premium. So all clear about risk averse and risk neutral. We'll come back to this again next week as well. To sum up, risk neutral, people does not care about risk. All they care about is expected return. For risk averse, people care both expected return and the risk. The higher the risk, the lower the utility. So they dislike risk. If we go back to this example, Mr. L being risk neutral, and he has two options to lend this $1,000. Option 1, lend to firm B. For 1 year, he got 10% interest from the loan. Option 2, he can invest in government bond with 8% interest in 1 year. Now, Mr. L is concerned whether firm B can pay back the loan or not, so he finds some additional information about the firm. He finds B's manager can choose one of two actions after he then lent the loan. Option 1, firm B will pay no dividend. There are more results inside the firm, so there's only 1% chance of bankruptcy. Only 1% chance they cannot pay back the loan. Alternatively, option 2, firm B pay high dividend. Less resource in the firm, 10% chance of bankruptcy. One last information, probability of firm B choose option 1 is 50%. Will Mr. L lend to firm B or not? So choose government bond or lend to firm L. How to make the decision? Yeah, this is risk neutral, so only care about expected return. For government bond, expected return is straightforward, $80, 8% fixed payment. Now, the key thing is, what is the expected return from lending to firm B? We have to figure out the profit for each case. So if firm B choose option 1, they have 1% chance of going bankruptcy. Then Mr. L can estimate his expected return. 99% chance he will get 10% of interest. With 1% of the chance firm go bankruptcy, he get nothing, so he will lose 1,000 principal as well. Total profit, expected profit will be $89. Similar idea for option 2. Now, they have a higher chance of going bankruptcy, so only 90% of the chance he get 10% interest, 10% chance he lose the principal. In this case, profit will be a loss of $10. This is not the expected payoff yet. This is given the firm choose option 1, the profit is $89. Given the firm choose option 2, the loss $10. But when Mr. L decides to lend to firm B or not, he does not know the firm will choose option 1 or option 2, so he still has to take expected profit from the two decisions. 50% chance, 89, 50% chance, lose 10. So final expected payoff, 39.5. Now decision is clear. It's lower than the $80, so Mr. L will not lend to the firm. Now what can we learn from this example? Because Mr. L is concerned about the firm paying high dividend, he has low profit. He anticipates this problem. He will try to protect himself by not lending to the firm. So he anticipates this foreseeable event. He protects himself by not lending to the firm. In other words, if this agency conflict is very strong, creditor will protect themselves by not lending to the firm. Alternatively, they might also charge higher interest. From the firm perspective, they might have high positive NPV project, and they're not thinking about paying high dividend. But if they cannot convince the creditor they will not pay high dividend, they don't have capital to finance the positive NPV project. And they will also lose money. So from firm perspective, they also have incentive to reduce agency problem, to get capital from the market. To do this, they can use that contract. So that's the first conflict. Now the second one, asset substitution. To explain the asset substitution, we first need to understand the payoff structure to debt holders and the shareholders first. You probably already know if the firm go bankrupt, then debt holder will be paid first, and any residual money go to the shareholders. If we draw in the figure, suppose this line, this black line, is the total debt amount, so both the principal and the interest amount. When firm value is below this line, all the money is collected by the debt holders. When the firm value is above this level, shareholder will get the residual amount. You can see the higher the firm value, payment to debt holder is fixed at this level, but payment to shareholder will increase. So this is the payoff structure. Now for asset substitution problem, this is about firm shift asset into riskier investment after a debt contract. When investment is more risky, the payoff can go extremes. It can be extremely high, it can be extremely low. That's a very risky project. When payoff is extremely low, firm making a lot of loss, then debt holder will bear the cost. They cannot collect the debt payment back. Alternatively, when the project payoff is extremely high, it's very successful, get a very high payment, then debt holders still have the fixed payment from the firm. All the good outcomes will go to the shareholders. Clearly, this benefits shareholder at the expense of debt holder. That's another conflict. Asset substitution. Firm investing risky project benefit shareholders at the expense of creditors. Now two more. Future increase in debt. Straightforwardly, future increase in debt level will increase the risk for original creditors. They are unlikely to collect the money back, so that's also a conflict. And last one, underinvestment. This problem is particularly for firms approaching bankruptcy. When firms approach bankruptcy, when they have positive NPV project, they generate positive payoff. Because it's approaching bankruptcy, all the payoff will be collected by debt holders, not by shareholders. In this case, firm has less incentive to invest in the positive NPV project, again, at the expense of debt holders. Any question about the conflict? So the third one, future increase in debt level. After the original debt holder lent the loan, firm issue new loans. They have fixed resources to pay a higher amount of loan, so original shareholder have more risk, are less likely to be paid in the end. Other question? Important thing to keep in mind is this different payoff to shareholder versus debt holder. Debt holder has fixed claim to the firm. Shareholder will claim all the residuals. We will come back to this problem when we talk about accounting information as well. Given all this conflict, we say that contract can solve the conflict, and we can use accounting information in that contract to reduce agency problem and align the incentive of the firm and the creditors. So second topic for today, accounting information and debt contract. One thing about the difference between accounting information and accounting policy. So the second topic today is accounting information. Here we usually mean specific accounting numbers. Net income, leverage ratio, level of debt. When we talk about accounting policy, that's the rule. Define how firm should account for certain transaction. In this course, we will mainly introduce two rows of accounting information. The first one is before the firm get the loan. And the second row is after the firm get the loan. One before, one after. For the first one, before the loan, accounting information can determine the availability and source of that financing. For the availability, we basically mean when a firm approaches a bank. The bank can use accounting information to decide firm can pay back the loan or not, and then decide whether to lend to this bank. So bank use accounting information to decide whether to lend to the firm. If the bank find accounting information is not enough, usually they can demand additional information from the firm. They might ask the manager to forecast the future revenue, forecast the future gross margin, forecast the future total sales. So these can all determine whether firm can pay back the loan or not. So useful for the creditors. If you look at the debt contract in practice, two information the bank is particularly interested in. The first information will be information about the downside risk. Again, go back to the payoff structure. We say debt holder has fixed claim to the firm. They care about whether firm will go bankrupt, whether firm can make the interest payment or not. So this is the downside potential. They care less about the upside potential. If the firm runs very well, have very high profit, these are all claimed by shareholders. Has nothing to do with them. So creditors care especially about downside risk. The second one, the time and riskiness of the future cash flows. So to what extent the firm have cash flow to make interest payment timely, to pay back the debt timely. So these are about the availability, whether bank will lend to the firm. At the same time, accounting information will determine the source of that financing. Source here mean firm will get the loan from public debt market or private debt market. Public debt market, usually firm will issue corporate bond in the market, and all investors can purchase the bond. So that's similar as the equity market. These are usually retail investors. If it's private debt market, then it's lending from a bank. That's the difference. What we find in practice, borrowers with high accounting quality are more likely to get debt from public market. Any idea why that's the case? High accounting quality, public debt market. Correct. Accounting firm with good accounting quality, retail investor can better estimate the firm's financial condition, and they're willing to buy the loan. Now, why not from the bank? Or why? So for a firm with low accounting quality, why more likely from a bank? To the public market or? Low quality accounting information they don't want to disclose to public market, then why approach a bank? Very good. The bank can get more private information. So even though I didn't disclose too much information in my annual report, I might be a good firm. The accounting quality is not very good. However, the bank can get more information, can ask me to provide information directly that can reduce information asymmetry, and the bank is more willing to lend the loan. So banks are more able to reduce adverse selection problem by collecting private information, by asking additional information from the firm. The second role we say is after the loan contract. The first one, before the contract, bank use accounting information to decide whether to lend to the firm, and the firm will, based on accounting information, decide to lend from public or private market. After the contract, accounting information can be used to design the debt contract. Here we further split into two aspects. One we call as formally. Accounting information can formally influence design of that contract. We say audited statement numbers can be included in the contract. We'll give you more details later on. The second approach, informally influence. For informally, we mainly talk about the firm's reputation of their information quality. For example, firm has reputation of providing timely information, providing high quality information. Then the bank are willing to provide to lend the loan with lower interest rate, are willing to lend the loan with longer maturity date. So here it's not about specific accounting number, it's the firm's reputation of information quality. Firm with good reputation more likely to get a favorable debt contract. We say this informal approach is about long-term effect. If you have good reputation, you can get a favorable loan this time. You might be able to get a favorable loan next time as well. As long as you keep the reputation, then you can always get this favorable loan. For the formal approach, it's short-term, it's restricted to this specific contract. You use net income in this contract, it will influence the design. The next contract, you have a different number, then the influence will be different as well. So their impact are quite different between the two approaches. What we will mainly talk about is this formal approach, how accounting number can directly influence design of that contract. If you look at a debt contract, you will usually see 4 components in the contract. These components exist for nearly all the contract. The first one, the principal amount that is borrowed. We call this as principal. In our example before, it will be this $1,000. The second one, interest rate charge. The third one, governance threshold. This is a key focus for today. Covenant, debt covenant. This is the restriction the borrowers agree to follow. Restrictions, debt covenant is the restriction borrowers agree to follow. For example, it can be a covenant about dividend payment. The creditor will say, if interest coverage ratio is below 2, then the firm cannot pay dividend anymore. So that's a restriction to the firm. And it's based on this interest coverage ratio. Threshold 2. So 2 is the covenant threshold in this case. Alternatively, the firm say if the debt to cash flow ratio is below 1, then the firm cannot issue new debt anymore. So threshold 1. That's the third component. Last one, maturity date. How long is the loan? Financial statement numbers can directly influence all these items. Let's give you a few examples. First one about interest rate. What we find is when firm with higher accounting quality, their loan has a lower interest rate. Higher accounting quality, lower information symmetry, less of a problem, so lower interest rate. Then we have maturity and security requirement. The first one, maturity. If we have higher accounting quality, longer maturity or shorter maturity? Longer, right? We have higher quality, less information symmetry, less concern, so longer maturity. Security requirement. This is the collateral for the loan. So house, land will be security, the collateral for mortgage loan. Then for firm, they sometimes will use their investment or asset as security as well. Now, higher accounting quality, larger or smaller security requirement? Smaller, yeah. Then we move on to this debt covenant. So that's the last item we're going to talk about. Covenants are the restriction in the debt contract, and they will usually depend on accounting numbers. A few examples, sub-covenant might mention if financial performance is really bad, creditors will control the firm. So they might say if the firm is making loss for 2 years in a row, then creditors will control the firm. They might reduce R&D expenditure to make sure the firm can pay back interest, can pay back the debt later on. So it's a very extreme case, shift of control. Restrict managers' action after debt issuance. So they can restrict dividend payment, they can restrict additional debt level. A few more cases you can see in practice very often, restrict capital expenditure. So a firm invests a lot, less resource in the firm, that's also a concern for creditors. Restrict asset sales. Firm have lower asset in the firm than higher leverage ratio, also a concern for the creditors. Last one, sweeps. Sweeps is usually about how firm should use the cash. They will say the firm has to use the cash to pay back debt. So for example, firm sell asset, get some cash, then in the debt contract, creditor will say you have to use this cash to pay back debt. You cannot use cash to make further investment. That's called as swaps. These covenants are usually very helpful to align the incentive to reduce the agency problem. If we go back to the example again, so talk about how covenant can reduce the problem, we go back to the example about Mr. L lent 1,000, want to lend 1,000. Before we compare this option to lend to a firm versus option to lend to the government, we say the payoff is lower from the firm because the firm might pay high dividend, then Mr. L will lose money. Now, if firm B has a positive NPV project, he really needs capital to invest. So how can the firm convince Mr. L and get the loan? Increased interest payment could be one example. So the firm will say, if without bankruptcy, I'll give you 20% of interest expense. Interest rate that will certainly increase the payoff, and then Mr. L will be willing to lend. But this is very costly for the firm. They have to pay a lot of interest. So is there a more efficient way to do this? One approach could be this covenant. In the contract, the firm B will commit to take the first action, will commit not to pay high dividend. Concern of Mr. L is firm pay high dividend. So to reduce Mr. L's concern, the firm should commit, I will not pay high dividend. How can they do this? They can add a covenant saying if debt to equity ratio is above a specified level, the creditor can control the firm. Debt to equity ratio above a specified level, creditor will control the firm. Why can this term convince Mr. L firm will not pay dividend? What happens if I pay dividend? Will go up, right? If I pay high dividend, equity of the firm go down. Then debt to equity ratio go up, Mr. L has the right to control the firm. As the manager, I don't want to lose control. That's a really bad signal to the market, so I won't pay high dividend to the shareholders. This is how the covenant acts as a signal to say the firm will not pay dividend. And from Mr. L's perspective, even if the firm pay high dividend, he will control the firm. Then he can take action to ensure he will get the debt back. He might cut R&D, he might reduce other cash flows, so he will make sure the firm can pay back the debt. So with this debt contract, now let's change the conditions. Option 1, firm pay no dividend, same as before, 1% chance of bankruptcy. Option 2, firm pay high dividend. Now Mr. L will take control. He will reduce some activity to reduce the chance of bankruptcy. So suppose now there's only 2% chance of bankruptcy. And we say with this covenant, firms are unlikely to pay high dividend. So we also assume under this debt contract, probability of firm choose option 1 is 80%. So more likely not to pay dividend. Now will Mr. L lend to firm B? Idea is the same, right? Compare the expected payoff. Option 1, profit will be the same. Nothing changed, so still $89. Option 2, firm pay high dividend. Now we have 2% chance of bankruptcy, so profit will be higher. 90% chance get 10%, 2% chance lose the principal. Again, this is under given the assumption firm choose a specific action. So to make the decision, we still need to consider the expected payoff from both options. 80% chance option 1, 20% chance option 2. So in the end, firm Mr. L will lend to firm B. You can see debt covenant can be a very cost-effective way for the firm to reduce agency problem. Specifically for firm not want to take action violate the creditor's interest. If they increase interest rate, that's very costly. They add a covenant, suppose they will never violate the covenant, then they directly convince the creditor to lend to the firm. Any questions so far? So we talk about the conflict between debt holders and the firm, 4 types of conflict, and then we talk about how accounting information can solve the problem. In accounting information using debt covenant is one. Accounting information help the bank to decide whether lend to the firm, also another one. The last topic for today, we will talk about what is the problem from using accounting information. We have mentioned before accounting information is useful to solve the moral hazard problem. However, when we use accounting information, it can also create new problems, and this problem is the earnings management problem. If that covenant is based on accounting information, so debt to equity ratio below a certain level, creditors will control the firm. Manager does not want this. They might hide that from creditors. So they will not violate the debt covenant. They will not transfer control to creditors. We call this as the debt covenant hypothesis. For a firm closer to debt covenant violation, manager has incentive to manipulate accounting report to avoid the debt covenant violation. That's a very intuitive problem from using accounting information. What is the assumption we make here? So first one, we say the covenant is based on accounting information. If it's not based on accounting information, of course, manager won't have incentive to manipulate. What else? We have information asymmetry. Manager can successfully manipulate. The creditors may not discover that problem. Also assumption. Something else? So it must be the case when firm is very close to the violation already. If it's far away from violation and earnings manipulation is costly, the manager should not manipulate. One more. Covenant is costly to the firm. So if the firm does not care about covenant violation at all, they would not have incentive to manipulate the statement. If they violate this debt contract, they can easily get a new contract from the market. They can easily arrange another loan from the market. Then the manager would not go through all the trouble to manipulate. What could be the potential cost of covenant violation? The first one, higher interest rate. If you violate this debt contract, creditor finds you pretty risky. Next contract, they might charge you a higher interest rate. At the same time, the firm might have a waiver fees. This is usually the case when they renegotiate the loan with the creditors. So suppose there is bad economy, so the firm is not performing well this year. They are close to violate the contract, the debt contract. But the firm still have good potential for future. So from firm perspective, it's good to keep the loan, keep the control. From the creditor's perspective, it's also good to continue lending this loan to the firm because they will have good payment in future. From both parties, they want to keep the loan, then they will renegotiate the contract. Usually in this case, they change some of the terms in the contract, but the firm will have to pay a fee to the bank. This is called as waiver fees. Fees to change the terms in the contract. renegotiation is actually very popular in practice. I think more than 50%, maybe around 80% of the loan have been renegotiated. So covenant violation happens quite frequently as well. Very good, yeah. For public debt market, it's hard to renegotiate. You can imagine there's so many retail investors purchase the bond, so it's hard to renegotiate. But for a bank, it's much easier, happens much more frequent. And this can have quite a big impact on the firm. So the data shows this is usually around 1 to 2% of the market value of equity for a firm. They can have significantly reduced welfare for the shareholders. If the firm violates the contract, the covenant, for the new contract or even for the existing contract, creditor might add additional restrictions to the firm. They might have restrictions on dividend, on additional borrowing, or extreme case, there might be shift of control rights. So these are all the potential costs for covenant violation. So we say under all these cases, closing to covenant violation, manager will manipulate report to avoid covenant violation. When manager manipulate the report, their target is usually either on earnings or on level of debt. They want a higher earnings, usually the case, they want to show a higher earnings on the income statement or lower debt on the balance sheet. That's usually the key focus for this debt covenant. Let's give you some examples. When the firm manipulates to increase the earnings, two approach, the most common two approach, one is accelerate revenue recognition. Increase revenue, then they increase the earnings. This is a very serious problem, especially before the new revenue recognition standard. After the standard, firm have less discretion, so hopefully this is less of a problem. Secondly, they might use real activities to increase the earnings. Straightforward example, R&D. They cut R&D expenditure, and then they can increase the earnings. These are the two approaches to increase earnings on the income statement. And for reducing level of debt on the balance sheet, the common one is off-balance sheet liability. They structure transaction in such a way they will not reflect as a loan on the balance sheet. Now let's give you one example for each issue. One about increased revenue, one about reduced level of debt. And for both cases, we use Enron as example. They have so many tricks, they have used so many tricks to manipulate financial statement. The first one will be about off-balance sheet financing liability. This is also the case that triggers the bankruptcy of Enron. All the problem is discovered after this problem. In 1997, Enron has invested in a project in a joint venture with a partner. And this partner wants to invest in a new project of Enron, so they want to buy out their investment in this project first and then use money to invest in the next project. Enron wants to buy out the partner's investment, so ideally, basically, they should get a loan from the bank, use the money to buy out the investment. But if that's the case, they will show a high level of debt in the financial statement. They don't want to do that, so they construct a special purpose entity called TrueCo. TrueCo is essentially controlled by the CFO of the company, CFO of Enron at that point. But Enron want to hide this, so they appoint another person to run the firm. And CFO will indirectly control that person to run the special entity. Also, Enron financed this TrueCo by getting a loan from another bank, not directly from Enron. And Enron provide guarantee for this loan. So indirectly, Enron still finance this special entity. Based on accounting rule, because of all the indirect relation, Enron does not have to consolidate the special entity in the financial statement. So they use TrueCo to get a loan and then use the loan to buy out this partner stake in the investment. By doing this, they hide $383 million from the financial statement. So significantly reduce the level of debt in the financial statement. This is about off-balance sheet liability. And then one example about creating fake sales transaction. This trick has been learned by the banking industry later on as well. It's being heavily used by Enron in this Nigerian deals. So the company is an energy company. They have selling budgets in Nigeria. And these budgets are essentially used to get a loan from Merrill Lynch. So you can see the fundamental feature of the transaction is a loan. Enron use the budgets as security and then get a loan from Merrill Lynch. However, Enron booked this transaction as a sales transaction to Merrill Lynch. So instead of reflecting as liability, they reflect as revenue. Even though they have repurchase agreement, they will get the budgets later on. Under the current revenue recognition standard, this is clearly not revenue recognition, does not satisfy the criteria. At that point, Enron book as revenue, so they reduce liability as well as increase revenue. Increase both earnings and also decrease liability. And this trick has been learned by the Wall Street. If you know the Lehman Brothers bankruptcy that's related to the Repo 105, the essence is exactly the same. Enron has been using this trick since the 1990s. Repo 105, for banks, they will usually have repurchase agreement with other banks. They need capital to do their business. They will get a short-term loan from another bank. So suppose we have Bank A want to get a short-term loan from Bank B. This is repurchase agreement. And Bank B wants some guarantee. So Bank A will provide some security to Bank B, and B will provide the loan to Bank A. After 24 hours, usually very short term, so 24 hours, A will pay back the loan and B will give back the security. So this is short-term borrowing. What happened for Lehman Brothers, in the accounting standard, it's at that time it's specified if the security is worth $90 to $102. For 100 loan, you provide security worth $98 to $102. Then it satisfies the criteria of short-term borrowing. So you should book a loan in the financial statement. But what Lehman Brothers did is provide security worth of $105. Then it's outside the range of accounting standard. They are not required to recognize as a loan, so they recognize as a sale. Again, hide liability, increase their revenue. So after other banks figure out this problem, it triggers the liquidity problem of Lehman Brothers, and then the bank just went bankruptcy. That's a pretty extreme case, hiding loan from investors. For most big banks, in the Wall Street, they still recognize such transaction as a loan. However, they also manipulate the level of debt from investors by manipulating the timing. So what do I mean? In US, banks has to issue, all listed firms will provide quarterly report. Every 3 months, they will provide the quarterly report, and the report will show the level of debt, the short-term borrowing the bank has involved. What most bank does is they will reduce this repurchase agreement at the end of the quarter. And then they will increase the level of this repurchase agreement at the beginning of the next quarter. The investor will think the level of risk is lower than what it actually is. So the red line is the level of debt at the end of the quarter, and the pink line are the level of debt during the quarter. You can see it's always lower at the end of the quarter. After the regulator discovered this problem, they already changed the rule. Now they require the firm in the quarter report, they have to disclose the level of short-term borrowing during the period as well. So they can not only disclose the level at the end of the quarter. They already try to reduce this problem. So to end this discussion, let's talk about how we can address this problem, how we can prevent firm manipulate report to avoid covenant violation. We talk about 3 potential approach. The first one, firm report more conservatively. If that's the case, they can have a lower interest rate from creditors. More conservatively, why that can reduce interest cost. If we have more conservative report, we will recognize losses on a timely manner. Revenue are likely to be lower, so we convey the information about downside risk more timely with creditors. We have conservative report, we recognize loss in a timely manner. So we communicate downside risk in a timely manner, reduce creditors' concern. Second one, high-quality auditors can improve the quality of accounting report and then lower the cost of debt. Clearly, this does not always work. For Anran, they also have the big auditor at that time, but still very big accounting scandals. Last one, creditors rely less on accounting-based covenant if financial information is less reliable. So if the firm has a lot of discretion in the accrual, creditors might rely more on cash flow information. Question about this earnings manipulation. So that's all the main topics for today. To summarize, today is about how debt contracting can reduce the problem between the firm and the creditors. One thing is, in this case, we consider shareholder and the manager as one team. We don't consider they have the conflict between each other. And then we talk about 2 roles of accounting information. So firstly, we talk about 4 conflicts, all different issues between debt holders and the firm, and then we have 2 roles of accounting information. One is before the contract, one is after the contract. Now, using accounting information creates new problem, earnings management problem. So creditors still should be careful what information to use and how to use it in that contract. That's all for today's lecture.